Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, January 6, 2020. And in this video, we'll take a look at the equity markets. I want to take a look at some of the top holdings, a couple breadth indicators, what's going on with breadth today. I'm noticing an unusual disparity between some of the major large cap stocks and in the lower tier within the Nasdaq 100. We have most of the heavy lifting being done by the FAANG stocks, the market leading FAAMG stocks. So I'm going to get to that in a second here, and I just want to start out with TVIX. I posted this as a trade setup. It's on watch. Again, not an actionable trade for a couple reasons. Number one, you have a downtrend line right here that's yet to be taken out. Now, I put the parameters in my notes on that. Some potential targets here. And like I said, I want to see a little bit more evidence of the markets breaking down. I listed some near-term support levels today, which we'll go over in this video. But I'm going to loop back over to the post that I made on that TVIX setup. And we had a great question down here, something that I've often said, you got to be careful using technical analysis, in other words, charting on ETFs, leverage ETFs, especially those prone to a lot of decay. And make it very simple. There are two factors that determine how bad, if at all, the decay on an ETF will be. What the leverage factor is it 2 times or 3 times? In other words, 200%, 300%. Obviously, the more leverage, the more the decay can work against you. It doesn't always. Sometimes it works in your favor. And the other thing is, what is the underlying security like? How volatile? Gold mining stocks, biotech stocks, of course, the VIX. There's really nothing more volatile. The VIX is probably even more volatile than natural gas, which is one of the most volatile things out there. Which, by the way, is another one that the decay can be quite awful. And I'm talking about the natural gas ETNs that are leveraged. Now, that being said, Ronco Tonko said, not sure if you should use technical analysis on TVIX. It's a leverage ETF with constant time decay, blah, blah, blah. Yeah, good point, and that is accurate. So my reply was yes, the decay over time is god-awful on TVIX, but over shorter term periods, such as the weeks or just a few months where those divergences are formed, the same divergences show through on the VIX. And I'm referring to the spot VIX. And the $ VIX, that's an index when you see the $ in front. So that's the spot VIX. Also keep in mind that I did a typo there, I'll fix that, that you cannot trade the VIX directly. Nobody can buy or sell the VIX. It is a theoretical, it's a calculated index, but you can't trade it directly, the spot VIX. What you can trade are futures on the VIX, which go out just like stock futures. You have near month, next month, several months out. You can trade options on the futures, the VIX futures, but again, those are not options on the spot VIX. Or you can trade any of the several ETFs that are out there that track the VIX. You have short-term VIX tracking instruments that track the short-term futures, medium-term, longer-term, leverage, inverse, all that good stuff. So I just want to make that clear, hence the reason for using this chart. I can give you price targets on the VIX all day long, but you can't trade it. So what I do is I estimate where we're likely to get reactions on TVIX, and if I trade it, I will over time. If I put it as an official trade, I may modify those targets if I see the VIX coming up to support. Let's say we enter a trade and we're in it for a week, 2 weeks, and we're getting to where the VIX is about to hit support, and I still have a little more upside to the target on TVIX. I may lower that target, or I may revise it, and then. So hence the reasons for the price targets there, because those are actionable levels that you can set a stop loss order to exit the trade. I'm sorry, a sell limit order or a stop loss order on the downside. Finally, I always look at the chart of VIX when analyzing TVIX, and I decided to post a setup since not only did they both have the positive divergences on the daily time frame, but they are both pushing up on downtrend line resistance, which I'll show you. With a buy signal to come on a solid break above the downtrend, which I'll get to here in a second, if and when we also have decent sell signals on the equity markets at the time. So that's it. So a lot of conditions, if you will. In other words, here's my VIX chart, and so this is the spot VIX index. There's the downtrend line, Again, that's why I posted TVIX. If this one breaks, you can see it's pushing up against the downtrend line recently. If the VIX breaks out, TVIX is going to break out, and vice versa, or within close proximity, because they have a similar downtrend line. So this is what I was talking about. How yes, over time you're going to see the VIX going like TVIX doing this, because the decay is bringing the value down, whereas the VIX has a floor. A VIX won't go to zero, can't go to zero, due to the way it's calculated, and you can look that up. As how it's calculated. It's using puts and calls, things like that. But there it is. So you can see the floor, if you will, or low end of the range that the VIX falls to, where over time TVIX will decay. However, as I said, going back just over a period of a few weeks or a few months, you'll pick up the same technical developments. You'll pick up similar downtrend lines, similar divergent lows, sometimes wedge patterns, uptrend lines, and therefore that's how you can trade the VIX. So I guess another way to say it, shorter term charts, 60-minute charts, daily charts, but paying most of your focus on these developments that occur over just a few months here, and I really wouldn't look at a long term like a weekly or a monthly chart that goes back 10 years or more on TVIX. You can do that on VIX, but not TVIX. All right, so with that out of the way, just so you know my mindset and how it works, in regard to analyzing the VIX, and then again, since you can't buy the VIX directly, we got to pick something, and since we or at least on the site I don't list futures or options as official trade ideas, sometimes I'll share my analysis there, I'll share it as unofficial trade ideas targets, but I do understand the majority of traders don't have either the experience or the means, whether they don't have a futures account or an options trading agreement. Therefore we stick with ETFs and individual stocks for the official trade ideas. Also below that post, and I always encourage you to come back into the site and check the comment threads below a post, anything that you're interested, any topic you're interested in. So earlier today I had mentioned here sort of a red flag or a yellow flag, if you will, in market breadth today, especially within the NASDAQ 100. So we'll take a look at that. Basically, at the time I did this earlier today, 2/3 of the stocks within the NASDAQ 100 were trading red at a loss, underwater, while the NASDAQ, while QQQ, the NASDAQ 100 tracking ETF, was actually up a pretty healthy, quarter point. And I looked at that, all 5 FAANG stocks, that's Facebook, Amazon, Apple, Microsoft, and Alphabet. If I did that all right, I always get that kind of thrown off because the G is Alphabet right there. So Facebook, Amazon, Apple, Microsoft, and Alphabet. They were all, of course, green, especially Alphabet being up really big. Yet then the QQQE, which I'll get to here in a second, that's the equal weighted NASDAQ 100, was down over 0.5%. That's a pretty big disparity. Again, they have the same exact basket of stocks, 100 different companies. Gives you about 104 securities, because some companies like Alphabet have 2 share classes. But when you see a disparity like that, a quarter point gain in one and the other's down 0.5%, it's not a very healthy sign. It's not a broad-based rally. It shows you that just a very few handful, in this case, a very few stocks, we're doing all the heavy lifting in the NASDAQ 100. So said that's something worth noting here. Okay, let's talk about that. Let's dig a little deeper into the breadth and how I came up with that number 2. Years back, I came up with a pretty useful tool. I could never find anything out there, and I still to this day don't believe anything exists where you can get real-time breadth statistics on just about any index, even a lot of sectors which usually don't exist. To the best of my knowledge, I don't think there's anybody out there publishing any breadth measurements on any individual sector, such as, let's say, semiconductor stocks or anything like that. So what I do, it's pretty simple. You can open a component watch list. This is on the TC2000 charting program. So I open up a component watch list. It has all 100 and we're on QQQ something. Yeah, there it is. Okay, so you see 104 items in the watch list. So what I'm going to do is drag this down a little bit and show you how I do this. Years back I put together a video showing you how to do this, but I'll show you right here. It's pretty simple. All right, so I like to sort them by market cap. First of all, I'll add a value column here, and fundamentals, and we go to capitalization, and then you can sort by size. This is how I like to sort my watch list here, and that shows you Apple being the largest company, publicly traded company in the NASDAQ 100, $1.4 trillion right there, and you can see all the big fangs right there. Now Microsoft turned red since I did that post earlier today. It was green. Now what you can do here is sort by gainers or losers. So when I click the percent change column, you see it's showing me all the winners here, and I'm going to go down and I'm going to click on the last of the green stocks. Last one's trading positive. Everything else is red down below that. And you can see it's changed a little bit. Earlier today, I think it was 32 or 33 when I made that post. So you can see 39 of the 104 items in there are trading green, which means obviously the other, what is that, 64, 65 or so are red right now. And then we still have, I got to go back to QQQ so I can just update you. Okay, we've given back some of the gains quite a bit already. We're still up on QQQ. We're up 0.011%, so about 0.1%. So that's how I get real-time breadth indicators. And again, when you have an index up, it would only make sense that at least half of your stocks, at least 50% of the stocks within that index or sector should be positive. Otherwise, you have negative breadth. And again, when you sort it by market cap, we faded some of those gains. You can see most of the green ones were up here in the top weighted. I go to the bottom tier of market cap right there. You can see, well, there's a couple, but you can see they're not very large gains. And again, when I did this earlier today, there was a bigger disparity. We've already started to see some profit taken on some of the big ones. But now I'm going to show you, let's move this to the side. Let's just, we can get rid of this list, or I can hide it down here. Yeah, we'll do that for now. So there's QQQ, and here's QQQE. QQQE is again the ETF for the NASDAQ 100 equal weighted index, where it puts every, gives each and every component an equal weighting, and you can see we're down 0.31. So they've closed that gap somewhat. And as I said in that post today, look, I've seen these disparities happen on short term, and if it's a short term thing, and then what happens afterwards, if the rest of those lower tier stocks, those smaller market cap stocks, start to play a game of catch up and they close that gap, or at least a good part of it, that's okay, because then you have a little more broad participation. However, if you continue to see that divergence, that's where it's a red flag. And so far, since I did that earlier today, you can see we've closed the gap, because now we're only down 0.31. Again, earlier today, this was the equal weighted was down 0.51 at the same time that QQQ was up whatever I said before, I think 0.3% or better. So that's they've closed the gap a little bit, but again, it's a trend to monitor. And one way to also look at that, now what I just showed you was real-time intraday breadth analysis. So again, things can change fast during the day. I try not to read too much in any one snapshot reading, but it is something to monitor. This is a long-term chart right here. This is a weekly chart, goes all the way back to the dot-com bubble. Even to the left of that, the chart gets cut off. I used to have those trend lines there. But what we had leading, this is the market top. Right down on the bottom here, this is the NASDAQ Composite Index, right? CompQ, and then NAADW, that's the NASDAQ advancing versus declining issues on a weekly time frame, weekly chart. And this was the dot-com bubble. That was up to the time the biggest drop in the NASDAQ 100. Might have even been bigger than the one we had in 2008. That was the next. Here's our bear market. It doesn't look like much on this chart because this is not log scaling. I can't set these comparison charts to log scaling, so it looks a little quirky here. But remember, that was a 50+% drop right there in the NASDAQ composite, as was that one, I believe, and quite a bit more actually. So the point is, what you look for are divergences. When everything is going well, you have the NASDAQ composite on the bottom. After the bear market was over in 2008, you can see stocks were rallying, right? This is the NASDAQ, and so was the NAADW, or the NASDAQ advancing versus declining issues. That means you had more stocks rising than were falling, and that's what you want to see in a healthy trend. That's what you saw here and here. Where it's not healthy is when all of a sudden the stock market is going up and you have more stocks falling than rising, and that's exactly what we have so far today, and even now with a little bit of an abatement of that disparity. But that's what you want to watch. Now, this is a long-term chart. This is a multi-decade chart with weekly readings. You know, when you set it to weekly, they're giving the values every week at the end of the week. And these divergences take many months, and it's in most cases years to build. The divergences leading up to the 2000 market top when the dot-com bubble burst, or 2000, yeah, early 2000, those were building for years. You had the stocks were ripping, and fewer stocks were carrying the market to new highs. You had more stocks falling than rising, and finally it paid off with a big bang. Same thing happened in 2007, I should say. We were diverging. You can see the divergent market going up, and then finally you can see right towards the top. This is the market top in October of 2007, right here. That's when the market peaked, and you can see there was, stocks continued to go up. It didn't look like a blow off top like we had in the Nasdaq back here. That was a blow off top right there. See the blow off top? I know I'm making a mess with the arrows, but what we had here is a noticeable drop off in the NAAD, the advancers versus decliners at the end. So you see that sharp drop right at the end where I had a divergence line going like this, and then it drops off. Here, let me clear those out and you can see it. So that's what marked the top back in 2007. Very few saw that coming, but this was one of the things I was watching, and I certainly saw that top coming a mile away. And you can see we've had a few periods in between where you had that as well. During the bull market, you had, again, this is right here from this point, back here in beginning, that was 2007 top. There's a bottom in March of 09. And this is our bull market. And throughout that bull market, you've had some smaller divergences right here. There's one right there. And they played out for, as the red boxes indicate, small corrections. This one was a bigger correction. The NASDAQ composite may have fallen over 20%. I know the NDX, the NASDAQ 100, fell a little bit under that. But there it is. There's a big drop right there. And again, it was foreshadowed by this divergence. So we have these divergences building. I have a line going from here to here, although the most notable level is right here. You have this divergence line going right here. Let me try to use this arrow tool down below. There's your divergence line steepening, and there's the NASDAQ composite. This to me is similar to a blow off top, similar to what we've had right there. Well, it depends. It's subjective. You could say that we're in blow off top mode now, and blow off tops can go on for a while, or that could be it. We had one similar to that back in 2017 in January. We had one right here, a small blow off top followed by correction. So I just wanted to point that out, that we have clear negative divergence between the advanced decline line on the NASDAQ. Some people look at the NYSE. I don't think it's that accurate of a index. This is what the market's all about. It's all about tech, and the NASDAQ composite is tech heavy. And so when this index breaks, I promise you it'll bring down the rest of the market when tech falls, because it is the largest component of the NASDAQ 100, the NASDAQ composite, the S&P 500. You have the heavy tech weighting, so that's one thing to note there. And real quick here, I won't spend a lot of time. This is a daily chart, same thing. You have that, except we have the NASDAQ composite up top, and I put the NAAD down below. This is a daily chart, so we're going back. We're going back all the way back to 01 as well, or close. We went back to 2000, the other one, but the same thing. You can see it on the daily chart as well. So you had a little divergent high right here at that point, and you had in the NASDAQ back then, you had a correction, and the divergence has only expanded and only built. And it's pretty stark. You can see with the NASDAQ composite just ripping like this right now, and you can see from this point here to here, it is not keeping up. And you can see you're not having a commensurate surge. You're having a little bit of a lift, but by far, I mean, it's diverging quite a bit. So I just wanted to point that out. And again, you can go back. They're all marked here. You can stop this video, pause it, look at these divergent highs. These dotted lines mark when the correction started to play out. In other words, when the market topped. And these were the big drops. Remember back in 2015, 2011. Of course, the market top back in October 2007 right there. It doesn't look like much on this scaling, again, because it's not set to log scaling, but that was over a 50% drop, and these were all big drops along the way. All right, so that's that, and again, something to monitor right now. As far as market breadth, there's a trend line on QQQE. If you want to follow that, if that broke, that could have some significance in the market. But let's go back. Let's look at the 60-minute chart, and we'll just drill down and look at a couple of the top components, see how they look. Because when those stocks, or I should say, until and unless those stocks break down, the market's not going to go very far. These pullbacks are going to get bought up, just like they did today with Apple hitting support. So I'm going to start out here with the QQQ 60-minute chart, same one I posted this morning before the market opened. I said we have to see 211.42 break, and that hasn't broken yet. Remember, that was support. I've covered this for the last couple weeks. We're above it. The buyer stepped in at the open. QQQ never even hit that level yet. Rallied back up. I still think, as I do this video, and I said earlier today, I've made a post, I think it's an objective short there. I don't guarantee it'll pan out. They bought this drop up aggressively today so far, but they rallied it right back into resistance. That's that same level I had there heading into the week, the Friday, the weekly market wrap, 214.34, and we're right about that level right now. 10 cents on a $214 security is statistically insignificant. It means we're right there trading on that resistance level right now, and minor downtrend line as well coming into play. So that's it. And when I say stop somewhat above, it's commensurate to where you're targeting. If you're looking for a gap backfill, like I think at best, or worst, I think, or minimum, I should say. At minimum, I should say the top of the gap there, 209, but I'm really leaning towards a backfill of that gap at 207.46. So if you're targeting that, you would go, you would say, okay, well, that's about a 3% drop. So I can use, even if I used a 1% stop loss, I mean, you can use, at this point, if we get close to the highs, we'll probably just keep, pop it and go above there. So let's say a very tight stop. Let's say right about, I'd say about a 0.5%. So you risk losing 0.5% to make better than 3%. That's over a 6-to-1 RR. That's probably about a 7-to-1 RR right there if you're targeting 207. And now if you're swinging for the fences, as I said before, you could trail stops down and hold out for more. It's all up to you as to how you trade that. Let's look at SPY real quick. SPY is still below that 323.33 resistance level. There's a recent couple lows right there. I should probably add another line right now. It's still 319.48 is the big level. That's the one I highlighted this morning. But now we have a few reactions here, so there's a level to watch as well. So 320.31. You can see 1, 2, 3, 4 right there, and several reactions from above and below right there. So there's another level, but that's a big one because that's the top of the gap right there. And then after that, you get a backfill if we break that level. All right, futures real quick. I know a lot of you trade futures, and I posted this one as well with the bounce back to 88.11 and a quarter. And again, close enough right now that it was just a little brief overshoot, and so I'm viewing this as just a stall, if you will, or getting checked on that resistance. We've been trading since we hit it, since I posted us rallying into it. We've traded really right on that level since. So let's see if that caps the bounce. I think it will. Like I said, it's up to you. You can wait to see a reversal and then short. You get a less favorable entry price, maybe a higher probability playing out, and you can see ES also right at the 32.32, 50-ish resistance level bouncing back. So I have the large caps bouncing back to resistance. I have still have that stark disparity, or I should say, negative breadth today in the most important index, the Nasdaq 100, and so therefore that's why I favor more downside. Okay, now what I'd like to do is just run through the top components of QQQ, because again, to me, it's all about this index. QQQ breaks 211.42. and starts to head down impulsively and makes a run at the at this gap right here, I can almost assure you SPY will be doing the same thing, and the small caps will probably follow. So let's just see what the index looks like, because again, these top weighted companies have such an impact. Okay, so today, no surprise, Apple hit that bottom of that price channel for the first time in a while, and it's been a clear pattern. This is where the buyers have been stepping in, and you can see these tags are almost, it's a pretty symmetrical, the moves down. So you hit the top of the channel, you reverse. Again, it's a price channel. That's trading, TA 101. You go long at the bottom and sell at the top, or reverse and go short. Watch, rinse, repeat. And now, sooner or later, all price channels end. Whether you break to the upside and just the channel's no longer symmetrical, or in the case of a rising channel, you're going to break usually to the downside and get a correction. So we hit that level today, but it held. So we'll watch it. And you can usually add a midpoint line to all price channels, or most price channels, and you'll see that midpoint line usually does a good job of defining, acting as support and resistance within the channel. And so right now, as you can see, we bounce back to the midpoint of the channel, which is resistance. And again, until this breaks down, unless the market is very unlikely to go down and hit those targets that I was just talking about on QQQ, because of the overweighting in Apple and the indexes. And so if it does break down, I've already shared my targets quite a bit recently, 6% drop there. And to keep in mind, that would have, we hit these targets, especially that 10%, we're probably going to, well, I can tell you we'll take out, we will exceed that gap. That gap pullback target on QQQ was not that much. It's only from where we're at right now. Let's just say things reversed from here and the gap was backfilled. You're talking a drop of 3.22%. And for Apple to drop, let's say, 6 and especially 10, that's going to take QQQ down more than 3.22%. All right, back to the other components. So there's Apple. And again, that's a big level to watch. If you're an NQ trader, even ES trader, until this breaks down, you can just, if you want to go long on the bounces, on the pullbacks to support, you can certainly do it. But at this point in time, with everything that I'm seeing, you may want to be on watch for a breakdown, especially an impulsive break and 60-minute close, to help confirm any sell signals or the next sell signal in the markets. All right, Microsoft. Microsoft has a similar price channel. Again, we're on the 60-minute charts here. And we had a little spike down this morning, but they bought the market up hard at the open, and that was, I think, largely in part to Apple falling to trendline support at the same time. So Microsoft had a little intra-period stick save, or an intraday stick save, meaning the candle, we went back up there, and following that, all the 60-minute candles closed right back, and see, we've been dancing on that level. So you really want to increase the odds of a short trade, replicate these charts, and go through and set price alerts on all these price channels, Microsoft, Apple. And all of a sudden, if you have one go off and then another go off within close proximity, that's a pretty good sell signal, and you need to probably jump on it pretty quick, because once the algos and as well as the humans see those breakdowns, I think there'll be a pretty quick rush for the exits there. All right, that's Alphabet, strong one today, one of the strongest. Nice reversal turnaround. There's a trend line you need to watch. Here's a couple horizontal price support levels to watch as well. I'm going to pull this one down just a little bit for a better fit, but these two are pretty accurate there. And again, there's your trend line. Amazon 60-minute chart, well above trend. Amazon put in a divergent low back here, and back at the time, that was in October, I said Amazon and Facebook were my two favorite. They were some of the most bullish looking stocks in there because they had nice divergent lows back then. There's the other share class, Alphabet, and there's Facebook again, early October, divergent low, highlighted at the time, and that one's rallied so far about 22% since then off that divergent low. And now we've come full circle. We have a divergent high, a bearish rising wedge pattern. Need to see this trend line break right here. I'll often include Intel is usually about coming in around the sixth largest component of the Nasdaq 100 into my analysis of the FAANG stocks, and you can see there's a nice uptrend line going back from August, and a clean little wedge pattern there, negative divergence you can see, and so we need to break this trend line in Intel. I'll probably do a separate video or an update on the semiconductors as well because I'm seeing a lot of levels to watch, developments. It's in an uptrend, just like the market is, but we have quite a few well-defined trend lines and other levels to watch on the semis, and we might have a trading op coming up on those soon. And that's about it. I'll just leave it here with Overstock because it broke out today. It was updated as recently as Friday. I was following this bullish falling wedge, broke out. As I said, it wasn't very impulsive. And then on Friday I said, if we pop 716, it should run. You can see it was a pretty nice defined out level, and that's a nice run so far. Almost about a 13% gain on the day. And really not a lot in the way of overstock until it gets to 919. I don't see much resistance, but as I said in that update, it'll largely depend on if whether or not Bitcoin continues to play out. I don't see why it won't. I like the chart. There's your divergent low right there, positive divergence on the daily. Remember, we're using the 60-minute chart on the official trade. We already hit our first target. We had a pullback, a reaction off that level, extended the divergent low, and we broke this minor trend line last week, and we're following through today with a nice lift, and that's carrying over into overstock. And then, of course, the other one to watch, which probably won't be too far behind. There it goes. Earlier today, it wasn't even up much. It started taking off, I guess, since I did that last update. This is a daily chart right here, and I mean, look how it trades. This is kind of cool. This is a 1-minute chart. It's a thinly traded stock. That's why these candles are funky. This yellow, that's Friday's close. But you can look at these levels. I mean, you can't make this stuff up. There was resistance there at 119. That's where we closed. And then this was the open right here. It popped up. And you can see at 123. I mean, I don't even have to put the lines. You can see it there. And then, boom, it broke out. I mean, this stock is clearly being driven by technicals right now. Like I said, it would follow, Bitcoin, Riot and Overstock are proxies, and they tend to trade in line. When Bitcoin's rallying, they tend to rally, and when Bitcoin's in a bearish trend, they tend to be in a bearish trend. But there it is. I mean, so it took out that 123, and boom, about a 4% rally from there, and it's up almost 8% on the day right now. And again, like I said, it's, sprinkle your eggs, around into many different baskets. Don't put them all in one basket, meaning diversify. And, some will pan out, some won't. But as of now, this one looks to be good up to about 181. It's at 127 now, and just breaking out today. Depends how I can play around. I can put this downtrend line here to be safe. Although I think this is the best fit right there with a little false breakout. But as you can see, just like I said on that overstock trade, need to clear that horizontal level. 130 is a big level here. So if Bitcoin continues to rally, I think the next buy signal and a nice catalyst for a rally will come on a solid break above 130. And from there, let's just measure from 130 to 181. That would be about a 38% gain. Aggressive company. Don't put all your money, a lot of money into this one. Never put all your money into any one stock, but this is Vegas money, speculative money, aggressive funds. Let's wrap it up here, guys. And like I said, I wanted to really focus on the broad markets now and keep an eye on those, the divergences with the breadth indicators, and we'll see what happens into the close today. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.